Hey traders, Ryan from blogstocks.com. This is a video on taking a trade from our InsiderFinance option flow platform and how we're going to evaluate the chart and the options chain before we take the trade. I've got here my dashboard, and I've actually got it sorted today on Moonshots. And what came up here on the unusual call volume was these tickers here, MGM, Las Vegas Sands, and GEO. But I thought I'd take this one here, Las Vegas Sands, and so what you do is you can click on it, and it's going to come up with the ticker research. And we can see that even just for the October 8th option, this is the expiring this week, we've got a lot of call volume. And in fact, we do have a dark pool print here of a large order for $19 million. And so what we got here is 0 puts and 23,000 calls. So this stock ticker is 100% bullish at the moment. What I like to do is I like to look down here in the real-time option flow to see what particular option you can buy to piggyback on institutional smart money flow. And if we sort here by expiry, we actually have maybe two expirations. We've got a long-term one here on March 18, 2022, and then we have an October 15th, 2021, and that's the one I'm going to look at. So it looks like here the strike prices for the October 15th, we've got anywhere from 38 to 42. So now what we need to do is look at the options chain in the chart to determine where in this range do we want to buy our option, and what would make the most sense. So I'm going to switch over to my Thinkorswim platform. And here's just the chart. It's interesting because I've already drawn in some Fibonacci levels here. And as I look at this, a couple things that kind of jump out at me. Number one is that on the daily, we're in somewhat of a downward trend because of the pandemic. But then here we've got a squeeze forming here, which means we're getting a coiling of energy or consolidation prior to an explosive move, whether that's up or down, I don't know. However, as we saw in the InsiderFinance, that it was 100% bullish, so we're thinking that the move is going to be up. They also have earnings coming up here on October 20th. And then another thing that jumps out at me here is the stochastic RSI, which we're getting into an overbought situation here. So what that tells me is, yes, there's still room for upward movement, but I believe it's going to hit some kind of resistance, and the next resistance level is this $41 range right here. So my thought is, because this is overbought on the stochastic, that it can move up. No guarantee that it'll move up, but it can move up according to the option flow. But my thought is, because it's overbought, that it's going to lose momentum or steam here at the $40 level. On the other chart here, I have this also by daily, and we've got a number one on the sequence counter, which means that it's counting that it closed above the previous two candles, and so that is possibly another upward indicator there. We also have the MACD going positive. It's it's crossed to the upside. So, and also the my RAF here, you don't have to have this one, but what it is it measures buyer and seller exhaustion. So you can see here that the momentum is sort of running out of sellers at this level, and then starting to pick up buyers in this range right here. So let's look at the options chain. I've got this here on October 15th, but before we do that, let's look at the put-call ratio at the bottom here. So we've got the put-call ratio at less than 1 or 0.1, very low, meaning that most of the orders are for calls. So if we go back here to the October 15th, let's look at a couple of things here before we determine which option or spread that we want to buy. Now, we want to look at the implied volatility right here that's being priced into these options, because it will give us a kind of a range that market makers think that LVS will trade within on or before October 15th. So I'm going to bring up my trusty calculator here, and I actually was already calculating that, but let me redo the calculation for you. So we're going to add the current market price of 38.11, 38.11, and we're going to add in the market maker implied volatility range here, 2.2 plus 2. I'm sorry, plus 2.2, and that gives us $40.31. So that gives us somewhat of an upper range for where market makers will think the price will go. And interestingly, that's right around the range of the first level of resistance. So it's just further confirmation in my mind that this price could go up, but it's going to bounce off this level of resistance and maybe come back down. Now, we don't know what's going to happen here with earnings. So it's possible that this is trading up into earnings in terms of a momentum, and we're just and that option traders are trying to take advantage of that volatility and price increase in their options. So it would make sense in my mind to buy an option at this level instead of trying to sell some kind of option, because the implied volatility is going to increase in your options, which will add value to the option in addition to the price increase. And the price increase will only go from $38 to maybe $40. There was one option on our InsiderFinance. Let me go back to that real quick here. There was one option here for $42. But in my mind, when I look at this, we got this overbought situation here, and the fact that market makers have got the range of implied volatility to $40, that it's, in my mind, unlikely that it's going to go to $42. If it does, whoever got those options could make a lot more money. But for me, the safe trade is to trade in this range here. So going back to the options chain, it would make sense to buy calls below $40 strike, because that's the upper limit of where the market makers think the price will go. Now, interestingly, we do have the most volume in this range as well, right here. So well, the way I would do it is you can either buy an at-the-money option here. It looks like that's where the heaviest option flow is, and that would be a good use of leverage because it's pretty cheap, and it's likely that the price will go from 38 to 40. Another way you could do it is you buy the 40, but there's some risk that you could lose money because there's no guarantee that the price will go to 40. And then the even safer way to play this is to buy what's called Delta 70 calls. And what that means is you're buying in the money calls. So for example, you could buy maybe this one here that's closest to 0.7 or 70. A little bit more expensive, but what happens is the price of the option will increase by the delta for every dollar that this goes up. So if you buy the $37 strike, that's 1, 2, 3 times $3 that it can go up, and it will go up by 0.683 times. So if we bring up our trusty calculator again, and so if it's currently going at, let's say it's that if you buy this, it's going at 1.58. So 1.58. Okay, so if we look at the delta, I'm sorry, I'm going to move this for just a moment. The delta was 0.68, so it could go up 3 times. It could go up 1, 2, 3 times if we trade up to $40. So what I'm going to do is multiply 0.68 times 3 times, and the value of the option can go up by 2.04 on top of your buying price here. And so that's $200. So feasibly, if you buy multiple options in the money range, that you could earn multiples of 200. And so, in my opinion, I mean, that's how I would play this, because not only will the price increase, but the delta may increase to 80, 90, or above because it's already in the money. And there's a lot less risk that you're going to lose money, because even if the trade goes against you and stays under 40, that you're going to retain some of the value of the option from the intrinsic value. So yeah, I'm going to go ahead and take a trade here. And what I've seen other option traders do is they actually take multiple trades. So for example, they might still buy the Delta 70, but then they'll also buy maybe the Delta, the at the money option, and then maybe a fewer of the out of the money option here. But what I like to do is I'm going to buy the $37 strike. So if you look here in our Insider Finance, so let's see what they were buying. They were buying the $38, $30, and $39 strikes. And so that would be the in the money 38 and 39. They're buying at the money options right here. So what you could do is you could buy the safe one, which is Delta 70, but also buy the $39 where most of the volume is, and we'll piggyback on the back of institutional money flow right here. And then what you want to do is the price of the stock gets near 40, you want to exit. And I would suggest exiting before it reaches a peak at 40. Maybe set your take profit level at something between 20 and 50% profit. Because if you wait for this to hit this range, what's going to happen is this entire volume is going to sell their options. And if you're too late, you're going to be left with a loss, holding the bag there. So that's why I like to trade in the money option in this case, and then maybe just a few more of the out of the money or at the money option, so that I'm not left as a bag holder. I hope that helps, and that's just one way to use the Insider Finance. And we were using the Moonshot filter to identify tickers that have a lot of volume and could make the most money. Enjoy. Happy trading.